Back in 2023, Orlando ranked as one of the hottest housing markets in the nation. But fast forward to 2025, and the story flipped. Listings have surged more than 44%. Prices are stalling, and some neighborhoods are showing the highest level of homes for sale since the last crash. As of March 2025, there are 8,396 single-family homes on the market and 4,418 condos, townhomes, and villas listed, a supply level not seen since 2008. And this isn't isolated to a single zip code. In Osceola County, inventory has doubled in just 2 years. Communities like Poinciana and Cross Prairie now report stock levels running 75% above the metro's average. For sellers, the uncertainty is growing. The biggest question hanging over Orlando now is simple. Will this surge in inventory force prices lower, or will sellers continue digging in their heels while the market recalibrates? For now, Orlando's median price remains parked around $375,000, virtually unchanged from a year ago. For nearly 3 years, Orlando's market has been stuck in neutral. After the pandemic-era spike faded, price growth simply stopped. Recent numbers paint an even sharper shift. In late March, the median price of a single-family home slipped 3% in 1 week to $410,000, while condos and townhomes sank nearly 6% in a week, dropping to $268,500. Seasonality plays a role. January closings always slow, but this year's drop was far steeper. Sales plunged from 2,154 in December to just 1,514 in January, a nearly 30% collapse, according to the Orlando Regional Realtor Association. Historically, spring rebounds the market, but not this time. With prices frozen for 36 months, the spring bounce has lost its momentum. The standoff between buyers and sellers is cracking, shifting control toward buyers. Homes are sitting longer, sellers aren't flooded with bids anymore, and weekly median prices are starting to slide. The investor retreat is where the story gets dramatic. In 2021 and 2022, investors were everywhere, grabbing properties at record premiums. But by 2025, investor purchases plunged 62% from their peak. That reversal isn't just visible on spreadsheets, it's showing up in painful losses. One investor who bought at $550,000 in 2022 sold for $391,000 in March this year, a 28% loss despite months on the market and repeated price cuts. And stories like this aren't rare anymore. Entire sections of Orlando filled with investor-owned homes are seeing forced selling, tax burdens, and insurance pressure push owners to walk away. These investor losses are reshaping Orlando's values. When a property sells far below its last purchase price, it becomes a comparable sale, a benchmark appraisers use. Buyers now hold leverage that would have been unthinkable in 2021. Local agents report buyers negotiating tens of thousands off list price, plus concessions like closing cost credits. A complete reversal from bidding wars and waived inspections. The rental market is also turning sharply. Nearly 8,000 new apartments hit the market in the first half of 2025, driving vacancy rates to 7 to 8%. Landlords who once could rent instantly are now offering incentives, waived deposits, free rent, and even gift cards. In Lake Nona, one tenant moved in with a waived $750 deposit and a month's free rent, enough savings to furnish their place and build a cushion. Luxury complexes near Disney and downtown confirm that at least 1 in 10 leases includes major financial concessions, and rents themselves are falling, 15 to 20% lower in many neighborhoods, as units sit vacant for 30, 60, or even 90 days. Housing analyst Nick Gurley isn't mincing words. He draws clear parallels between today's Orlando market and the build-up to the 2008 crash. With inventory levels at their highest since that era, Gurley warns that if demand doesn't bounce, Orlando could face a multi-year slide. His models estimate Orlando homes are 18% overvalued, predicting a 6% metro-wide price drop over the next year, steeper than many national projections. The danger, he argues, lies in investor-owned properties flooding the market all at once. If too many investors exit simultaneously, the flood of listings could deepen price declines just as it did last cycle. Mortgage rates drifting downward complicate the picture even more. After nearing 7% in 2024, rates settled below 6.3%, stirring faint momentum among sidelined buyers. But despite the improved affordability, many owners refuse to list rather than accept lower prices. Orlando sees about 28 listings withdrawn per 100 new, far below Miami's 59 or Tampa's 33, but still significant enough to signal seller hesitation. The market now sits at a junction. Orlando's housing landscape has shifted from scarcity to surplus. Prices are stalled. Buyers are cautious but empowered. Sellers are resisting, but cracks in the armor are appearing. What happens next won't just determine property values. It will determine who can afford to stay in this city and who gets priced out or forced out. With inventory soaring and affordability stretched, local leaders, including state officials, are watching closely. Their response could shape whether Orlando stabilizes or sinks deeper into correction territory.